Financial Education is a very popular finance channel on YouTube. He released a video in which he explains the stocks that he believes has the most upside. So in this video, I'm going to give my opinion on them, as well as revealing the stock that I believe has the most upside. And the first stock he gave is the Cheesecake Factory, which is an American restaurant chain, and it's a small company as the market cap is $2.7 billion. The stock is up 10% in the past year, although if we look at the last month, it had a recent run-up of 18%, which was due mainly because in general small caps have had momentum, which is clear if we take a look at the Russell 2000 index that tracks small cap companies. The revenue has not grown very fast but very consistent in the past decade, from $2.1 billion to $3.7 today. And obviously we shouldn't take the COVID year into account, which was obviously a fluke year. And analysts are expecting this consistency to continue as they have the Cheesecake Factory reaching $4.4 billion by 2028. So around 5% compounded annual revenue growth. Regarding profit, their net income recovered nicely from COVID and it is currently at $106 million. And the same goes with their free cash flow. Regarding their margins, gross margin is around 40%, profit margin and free cash flow margin are around 4%, which is normal for a restaurant chain company. And analysts are expecting double-digit growth from profit as they have the Cheesecake Factory reaching $5.06 per share in 2028. If you assign a 15p to the company then, it would make it an $84 stock, meaning 51% upside from current levels, so nice returns according to analysts. Now this company has a substantial amount of debt. If we look at their balance sheet, they have $189 million in cash and $2.1 billion in debt, which is a lot for a company that has a market cap of $2.7 billion. Now that being said, a lot of that debt are leases, and therefore I wouldn't worry as much. Then, in order to calculate the intrinsic value of the company and potential future returns, I use my Google Sheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, the intrinsic value according to my low assumptions is $34 per share, middle $50 and high $70. And because the stock is trading at around $56 per share, this means that if my low assumptions occur, you would get a 1.3% annual return on your money, middle 8% and high 14%. Now I believe my assumptions are reasonable as I have the Cheesecake Factory growing revenue annually between 4 and 6%, averaging a profit margin and free cash flow margin between 3 and 5%, and I assigned a PM price to free cash flow at the end of the 7 years of 14, 15, and 16. And if we go back and put our 10% return for intrinsic value, the reason I put 10% is because that is what the market gives you. We can conclude that the company is trading around fair value. However, his average cost is around $40 per share, and therefore I agree with his purchase at that price. But after the recent run-up, I believe there are just better opportunities in the market. The next stock on his list is Salesforce, ticker symbol CRM, which is down 19% in the past year, and analysts have them rated as a buy with 21% upside. This company, contrary to the Cheesecake Factory, is quite big as the market cap is $249 billion. They sell a software for large companies, mainly. For example, some of their clients are CVS or Costco. They have seen very good revenue growth from $6 billion to $40 billion currently. And last quarter, they increased guidance from 8 to 9% to 9 to 10%. And their revenue is expected to keep growing at around 10% per year for the next 6 years and reach $66 billion in 2031, which I am not surprised because their revenue is very sticky, meaning it is very hard for companies to switch older software into a new one. And because this is a software company, their profit is amazing. Net income currently at $7 billion, and one thing that I like is that they have a ton more free cash flow, currently at $12 billion. Their margins are also amazing with gross margin at 77%, profit margin at 19%, and free cash flow margin at 31%, with a recent jump in the last few years. And they have an exceptional balance sheet as they have the same amount of cash than debt, which is $11 billion. Regarding the spreadsheet, I have intrinsic value between 179 and 358, and the stock is at 266. So again, I think the company is trading at around fair value. And I believe my assumptions are reasonable as I have the company growing revenue between 7 and 11%, averaging a profit margin between 20 and 30%, And I assigned the PM price to free cash flow at the end of the 7 years of 16, 18, and 20. But if you want to make your own assumptions, I'm going to leave a link to a spreadsheet down below. It is very simple to use because I've done all the calculations in the background, so you only need to input your assumption. Again, his average price is 243, which I would say is a good entry point. I personally need more of a discount from current levels, although I would argue this is a solid buy today. The third stock is Adobe, which is down 27% in the past 5 years. The sentiment is horrible around this stock, mainly because AI is set to replace Adobe. If AI is good enough for generating videos and photos, why would you manually need Adobe? Another fear is that competition has increased from cheaper alternatives such as Canva and Figma that are taking market share. I am against this belief because according to their data, 70% of their customers are professionals and 90% of their revenue comes from professionals. And what I mean by professionals is people who are working in a company, for example for Coca-Cola, Nike, or even a small marketing firm. It is a software for professionals. I believe this is important to answer the question, will AI take over Adobe? Because for a low-end user or customer, this might be the case. If AI gets good enough, you might be able to use cheaper alternatives. For example, if you're a YouTuber that only uses Adobe for thumbnails, but if you're Nike and are spending millions of dollars in ads, you need control and perfection, which is something that generative AI will never offer. And Adobe, in a sense, will benefit from AI, which they are already making through AI-integrated features. And if we look at the numbers, fundamentals haven't stopped growing. The revenue has grown in the past 10 years from $4.7 billion to 23 currently. And analysts are still projecting very good revenue growth in the next years as they have Adobe reaching $24 billion this year and grow to $35 billion in the next 5 years, which is a compounded annual growth rate of around 9%. Their profit has also seen massive growth in the past decade, growing from $600 million to almost $7 billion today. And they have even more free cash flow, currently at $9.5 billion. Analysts are also expecting profit growth. Regarding earnings per share, they have Adobe reaching $21.25 per share this year and grow to $34.14 by 2030. This is normal because Adobe has fantastic margins with gross margin nearly at 90%, profit margin are around 30%, and free cash flow margin at 40%. Another thing that is going to drive EPS is share buybacks. As the stock has gotten cheaper, management has decided to buy back shares. This is very positive for investors because you share the profits of the company with less people and you own a larger portion of the company basically by doing nothing. Then, according to my assumptions, I have intrinsic value of 244 according to my low, 346 according to the middle, and 478 according to the high. And because the stock is currently at 338, it means that if my low assumptions occur, you would get a 4.3% annual return on your money, middle positive 10.4%, and high 16.4%. So I believe Adobe is slightly discounted currently, and his average price is $350, so I would say it's a decent buy. And the next company on his list is e.l.f. Beauty, down 33% this year. Although since recent lows, the stock is up 20%. It's a medium-sized company with a market cap of almost $5 billion, and analysts have them as a buy with 58% upside. This is a very famous beauty company in the US. They have seen a lot of growth, especially in the past 3 years or so. As you can see the revenue chart, and they are currently generating $1.4 billion. And they guided for 18 to 20% revenue growth for this year, and analysts have them reaching $2.1 billion by 2028. So very fast growth. Analysts are also expecting insane profit growth from $2.88 per share this year to $4.42 in just 2 years, which is normal as their profit is growing at a very fast pace in the past 3 years. Free cash flow has grown from $14 million in 2022 to $141 currently, and they have a decent balance sheet with $194 million in cash and $970 million in debt, which is manageable for a company of a market cap of $4.9 billion. Regarding the valuation, they are trading at a 4P of 26 and price to free cash flow of 34. And according to the returns, you would get, with my assumptions, a negative 0.8% according to the low, 9.5% according to the middle, and 19% according to the high. So I would say it's trading at around fair value. However, I believe there is a lot of growth priced in for this stock, which is why it's a pass for me at the moment at current prices. But as you can see, his average price is $7, and he's got returns of almost 1000%, which is insane. So I wouldn't buy the stock at today's price, but he's done tremendous. And if you're a value investor, you know that picking the right stocks isn't just about the story. It's about mixing it with the numbers. And that's exactly where stockanalysis.com comes in. This site lets you dig deep, track up to 10 years of historical financial performance. You can see revenue, profit, margins, dividends, everything. If you want a discount code, you have mine in the description. They also have a free newsletter that highlights important market moves and stock fundamentals. Perfect if you want to stay informed without spending hours digging through data, which I will leave in the pinned comment. And the next stock is Estee Lauder, up 45% this year. Another company in the beauty sector selling mainly skincare products. It has a market cap of $38 billion. And if you decide to invest in this company, it's because you believe in the turnaround play, because this company has been struggling. Revenue is down from an all-time high of $17 billion to $14 billion currently, and net income from $2.8 billion to negative $430 million. A sign for recovery, though, is that free cash flow has remained positive, and it is currently at $1 billion. And before this fall, they used to have very good margins between 11 and 14%. Analysts are expecting the turnaround to happen as they have them reaching almost $18 billion in revenue in 2030, which would be an all-time high. And as far as EPS, grow from $2.22 per share this year to $5.31 in 2030. Now, in my discounted cash flow model, I also assumed the turnaround would happen, because otherwise there is no reason to invest in this stock. But as you can see, I have intrinsic value between $46 and $106 per share, and the stock is now at $108 per share. Therefore, in my opinion, even if the turnaround does happen, the stock is too expensive at the moment. However, his average price is $69 per share, which I think is a great average. And the last stock on his list is Shopify, which again is a company that has amazing fundamentals. However, the valuation is just too expensive at the moment. The stock is currently trading at a PE of 122, which is very, very high. And remember that in investing, as a value investor, the more you pay for something, the less your returns are going to be. And the less you pay, the more your returns. And also in Shopify, like in many other stocks, he's up already 157%. So again, I think he has a great average, but the stock is not a buy at current prices. And now I'm going to share what stock I believe has the most upside. And that stock is PayPal, down 75% in the past 5 years. I've done tons of videos on my channel in case you want a more in-depth analysis. But basically what I believe is that everyone thinks PayPal is a dead company. However, fundamentals keep getting better and better. Revenue is still growing from $9 billion to $32 in the past decade, and analysts still expect growth around 6% per year. Net income is at an all-time high of $4.9 billion. Free cash flow is even higher at $5.5 billion. They have very good margins, with gross margin being at 41%, profit margin at 14%, and free cash flow margin at 16%. And they are buying back a ton of shares, which is amazing for investors as you own more of the company and share the profits with less people. Which is why analysts are also expecting growth regarding profit, from $5.46 per share this year to $9.23 per share. If you assign an 18p to those earnings, it would make it a $166 stock, meaning 184% upside, which is huge if analysts are correct. And according to my spreadsheet, I have intrinsic value of $68 according to my low assumptions, 96 on the middle and 131 on the high. And because the stock is currently trading at $58 per share, it means that if my low assumptions occur, you would get the 13% annual return on your money, middle 20%, and high 26.5%. And I made conservative assumptions. I have PayPal growing revenue between 4 and 8% for the next 7 years, averaging a profit margin and free cash flow margin between 13 and 17%. I assigned the PM price to free cash flow at the end of the 7 years of 14, 16, and 18, and I didn't even assume any share buybacks just to be more conservative. But if we go back to our 10% intrinsic value and assume they buy back 2% of their shares annually for the next 7 years, the intrinsic value becomes even more attractive. When you find cases where fundamentals keep getting better and the market sentiment for some reason is negative and pushes the stock price down, you get opportunities like this. And it reminds me in this aspect of when Meta was trading under $100 per share, which I recommended buying on this channel, or when Alibaba as well was under 100, which I also recommended buying. I hope you found this video valuable. Let me know what you think about these stocks in the comments, and I'll see you in the next one.